Before we dive in, it's crucial to understand that the information in this presentation is for educational and informational purposes only. It is not, and should not be considered, financial or investment advice. Trading foreign exchange on margin carries a high level of risk and may not be suitable for all individuals. The high degree of leverage can work against you as well as for you. Before deciding to trade, you should carefully consider your investment objectives, level of experience, and risk appetite. The possibility exists that you could sustain a loss of some or all of your initial investment, and therefore you should not invest money that you cannot afford to lose. We are not financial advisors. Please consult with a licensed financial professional for advice tailored to your specific situation. Past performance is not indicative of future results. 90%. Let that number sink in for a second. 90% of aspiring Forex traders in the United States fail. They quit. They blow up their accounts and walk away, convinced it's all a scam, or that they just don't have what it takes. They see the dream of financial freedom, of controlling their own schedule, of making money from a laptop anywhere in the world, and they watch it evaporate in a series of bad trades and gut-wrenching losses. Why? What do the 10% who succeed know that the 90% don't? It's not a secret algorithm. It's not some $1,000 indicator. And it's definitely not luck. The difference is that they avoid a handful of critical catastrophic mistakes that almost every single beginner makes. Mistakes that are entirely preventable. This video is your blueprint for avoiding those mistakes. We're not going to talk about guaranteed profits or secret strategies. We're going to give you the 5 foundational, non-negotiable tips that can form the bedrock of your trading career. These are the principles that separate professional-minded traders from gamblers. By the end of this video, you will have a clear, actionable framework to start your Forex journey the right way. A way that puts you in a position to potentially join that 10%, instead of becoming another statistic. So if you're tired of the confusion, the hype, and the fear of losing money, you're in the right place. Let's get started. The very first and arguably the most important tip is this. You must treat trading like a business, not a hobby or a trip to the casino. This might sound simple, but it's the single biggest mindset shift a new trader has to make. Think about it. What's the difference between a hobby and a business? Hobbies cost money. We spend money on golf clubs, on fishing gear, on video games because we enjoy them. The financial return isn't the point, the entertainment is. A business, on the other hand, is meticulously designed to generate a profit. Every decision is calculated. Every expense is tracked. There's a plan. When you approach the Forex market like a hobbyist, you make emotional decisions. You chase a hot currency pair because you saw someone talking about it online. You risk way too much on one trade because you have a good feeling about it. You take a loss personally, get angry, and then jump right back into the market to try and win your money back. A disastrous strategy known as revenge trading. That's hobby thinking. That's gambling. A business owner would never operate that way. A CEO doesn't run their company based on a gut feeling. They use data, they have a plan, and they manage risk. So how do you, as a new trader, start acting like the CEO of your own trading business? You start by creating a formal trading plan. This is your business plan. It's not optional. It's the document that will guide every single decision you make. Your trading plan needs to have, at a minimum, 4 key components. First, your goals. And I mean specific, measurable, realistic goals. I want to get rich is not a goal, it's a wish. A business goal sounds like this. My objective is to achieve an average return of 3% per month, with a maximum drawdown of 10% over the next 12 months. See the difference? It's precise. It's measurable. It gives you a benchmark to evaluate your performance against. Your goal isn't to make $1 million by next week. Your goal is to execute your plan flawlessly. The potential profits are a byproduct of excellent execution, not the primary focus. Second, your strategy. This is the product your business offers. How are you going to identify trading opportunities? What are your exact criteria for entering a trade? What specific technical indicators will you use? What chart patterns are you looking for? What time of day will you trade? For example, a rule in your plan might be, I will only enter a long trade on the euro to US dollar pair during the London session if the price is above the 50-period moving average on the 1-hour chart and the relative strength index is below 30. That is a concrete, non-negotiable rule. It removes emotion and guesswork. You're no longer just clicking buttons based on a whim. You are a business owner executing a predefined operational procedure. You either see the setup that your plan demands or you do nothing. The hardest part of trading isn't pushing the buy or sell button. It's the discipline to sit on your hands and do nothing when your specific criteria aren't met. Third, and this is the one that will save you, is your risk management protocol. This is your business's finance department. A business that doesn't manage its cash flow goes bankrupt fast. A trader who doesn't manage risk blows up their account. It's that simple. Your plan must state, in no uncertain terms, the maximum percentage of your account you are willing to risk on any single trade. For beginners, the industry standard and highly recommended rule is to risk no more than 1 to 2% of your capital on a single trade. Let's be crystal clear about what this means. If you have a $5,000 account, 1% is $50. That's it. That is the absolute maximum you are allowed to lose on one trade. If the trade goes against you and you get stopped out, you've lost $50. You're not emotionally devastated. You haven't crippled your account. You can wake up tomorrow and execute your plan again. But the hobbyist, the gambler, they might risk $500 or even $1,000 on that same trade. If it goes wrong, they've lost 10 to 20% of their entire capital in a matter of minutes. After a few losses like that, their business is bankrupt. Your risk management rules are your ultimate survival tool. Fourth, your record keeping. Every successful business tracks its performance. They have profit and loss statements, balance sheets, and performance metrics. Your version of this is a trading journal. Every single trade you take, win or lose, must be documented. You should log the date, the currency pair, your reason for entry, your exit point, the profit or loss, and most importantly, your emotional state during the trade. Were you feeling confident, anxious, greedy? After 20, 50, 100 trades, this journal becomes a goldmine of data. You can go back and see that maybe you lose money every time you trade on a Friday afternoon. Or maybe your strategy works great on certain pairs but fails miserably on others. The journal exposes your weaknesses and highlights your strengths. It is the single most powerful tool for improvement you will ever have. It turns your experiences, both good and bad, into priceless lessons. It's the data that allows you, the CEO, to make informed decisions to improve your business's performance over time. And because you're operating in the United States, thinking like a business owner also means you have to be aware of the financial and legal structures. Down the road, you'll need to understand how the IRS views your activity. You'll want to speak with a qualified tax professional about topics like trader tax status versus investor status, or the potential implications of a mark-to-market election. We're not giving tax advice here, but the point is that a true business owner thinks about these things. They plan for tax liabilities. A hobbyist doesn't. So your first step isn't to learn a complex strategy. It's to change your entire mindset. Stop being a hobbyist looking for a thrill. Start being the founder and CEO of a startup. You Incorporated. Your trading capital is your startup funding. Your trading plan is your business plan. Your risk management is your finance department. And your trading journal is your performance review. This framework gives you structure and discipline in an environment that is designed to prey on your emotions. It's the foundation upon which everything else is built. Without it, the other 4 tips we're about to cover won't matter. So with that foundation in place, let's talk about the second critical tip, which is arguably the one that separates traders who last for a decade from those who last for a week. And it's this: become an obsessive, absolute master of risk management. Now I know what you're thinking. Risk management? That sounds boring. I want to learn about the secret indicators, the killer strategies that make the big money. I get it. We're all drawn to the exciting stuff, the offense. But let me tell you a quick story about a trader I knew years ago. Let's call him Alex. Alex was smart. He devoured charts, he understood economic news, and he developed a trading plan that was actually pretty solid. On his first week trading a live account, he made 3 incredible trades. He was following his plan and it was working. He turned his initial $5,000 into $6,500. He felt like a genius, like he'd cracked the code. The next week, he saw a setup that looked almost identical to one of his winning trades. The euro was rallying against the dollar. His plan told him to enter the trade, and critically, it told him exactly where to place his stop loss, the preset order that would automatically get him out of the trade if it went against him by a certain amount. His plan dictated he should risk no more than 1% of his account, which was now $65. But Alex hesitated. He thought, this is a sure thing. Why would I risk only $65 when I could make so much more? The trend is so strong. So, he decided to risk $500 instead. He moved his stop loss way down, giving the trade room to breathe, as he told himself. For a few hours it worked. The trade went in his favor, and his potential profit was huge. The adrenaline was pumping. He felt invincible. Then, an unexpected announcement came out of the European Central Bank. It wasn't on the economic calendar. It was a complete surprise. The market reversed hard and fast. In less than 5 minutes, the price plunged through his original stop-loss level. Then it blew past his new, much wider stop-loss and kept going. By the time he could manually close the trade, his $500 risk had turned into a $2,000 loss. In a single trade, he wiped out all his previous gains and a chunk of his starting capital. He was devastated, confused, and angry. He had a winning strategy, but he lost. Why? Because he ignored the single most important rule of the game. You don't get to decide how much you win, but you absolutely get to decide how much you're willing to lose. That is the essence of risk management. It's not about avoiding losses. Losses are inevitable. They are a business expense in the world of trading. The best traders in the world lose trades all the time. Risk management is about ensuring that no single loss, or even a string of losses, can ever take you out of the game. It's your financial survival kit. The most fundamental concept here for beginners in the United States is the 1% rule. It's simple, but it's profound. It states that you should never risk more than 1% of your total trading account on any single trade. If you have a $10,000 account, your maximum risk per trade is $100. If you have a $1,000 account, your maximum risk is $10. This sounds small, maybe even pointless. But let's look at the math, because the math doesn't lie. If you risk 10% of your account on each trade, it only takes 10 consecutive losses to wipe you out completely. 10 losses in a row might sound unlikely, but in the chaotic world of Forex, it is absolutely possible. The market can and will go on streaks that defy all logic. Now, what if you use the 1% rule? To lose your entire account, you would need to lose 100 trades in a row. 100. Think about that. If you have even a remotely viable trading strategy, the statistical probability of losing 100 consecutive times is astronomically low. The 1% rule gives you longevity. It allows you to make mistakes, to learn from them, and to still be around to trade the next day. It transforms trading from a lottery ticket into a long-term business. So how do you actually enforce this? Through a tool we already mentioned, the stop-loss order. A stop-loss is not a suggestion. It is not an admission of failure. It is a non-negotiable business tool. When you enter a trade, you must know down to the exact price where you will get out if you are wrong. You place your stop-loss order at that price the moment you enter the trade. You are pre-committing to your maximum loss. This takes the emotion out of it. You're not sitting there watching the trade go against you, sweating, hoping, and praying it will turn around. You've already made the cold, calculated business decision before your money was even at risk. But there's a second piece to this puzzle. Limiting your risk is only half the equation. The other half is ensuring your potential rewards justify that risk. This is called the risk-to-reward ratio. Think of it this way: would you risk $100 for a chance to win $10? Of course not. The math doesn't make sense. Yet, countless new traders do the digital equivalent of this every single day. A common guideline for beginners is to only take trades where the potential profit is at least twice the amount you are risking. This is a 1-to-2 risk-to-reward ratio. If you're risking $100 on a trade, your distance to your stop-loss, your profit target should be at a level that would net you at least $200. Why is this so powerful? Let's go back to the math. If you maintain a 1-to-2 risk-to-reward ratio, you can be wrong more often than you are right and still come out ahead. Think about that. You could have a trading strategy that only wins 40% of the time. You lose 6 out of every 10 trades. But because your winners are twice as big as your losers, you are still profitable. Let's say you make 10 trades. You risk $100 on each. You lose 6 trades, so that's a $600 loss. 6x $100. But you win 4 trades, and because you're aiming for a 1-to-2 ratio, each win is $200. That's an $800 gain. 4x $200. Your total gain is $800. Your total loss is $600. You walk away with a net profit of $200, even though you lost more trades than you won. This is the mathematics that underpins professional trading. It's not about having a crystal ball. It's about having a statistical edge and applying it with discipline over and over again. Pros don't hunt for certainty. They hunt for favorable odds. They act like the house in a casino, not the gambler. The casino doesn't know if the next spin of the roulette will be red or black, but it knows that over thousands of spins, its small statistical edge will result in consistent profits. Your risk-to-reward ratio is your edge. Combining the 1% rule with the positive risk-to-reward ratio is the cornerstone of a defensive trading strategy. It shifts your focus from, how much can I make on this trade, to, how can I protect my capital while seeking out high-probability opportunities? This mental shift is everything. It's what separates the amateurs who chase thrilling wins from the professionals who methodically manage risk to build wealth over time. So, your trading plan is your map. Your risk management strategy is your armor and your shield. It's the boring, unsexy part of trading that's responsible for nearly all long-term success stories. You can have the best map in the world, but if you march into battle without armor, you won't last very long. Now that you have your blueprint and your armor, it's time to choose your battlefield. You can't trade everything. You need to focus. And that brings us to our third and perhaps most misunderstood tip for beginner traders in the United States. Master one, not many. Think about it like this. Imagine you wanted to become a world-class martial artist. Would you spend 1 hour a day learning karate, an hour on judo, an hour on boxing, an hour on taekwondo, and an hour on Muay Thai? Or would you dedicate all 5 of those hours to mastering just one discipline? The person who dabbles in everything becomes a jack of all trades but a master of none. They know a little about a lot, but they can't compete with the specialist. The person who dedicates themselves to one art form, let's say boxing, learns the nuances. They understand the footwork, the timing, the subtle feints, the tells of their opponent. They develop an intuitive feel for it. Forex trading is no different. You are entering an arena with specialists. And your third tip is to become one yourself. Specialize in just 1 or 2 currency pairs. When you first open a trading platform, it's like walking into a candy store for the first time. You see dozens of options. There's the euro to US dollar, the pound sterling to Japanese yen, the Australian dollar to Canadian dollar, the NZD/CHF. The list goes on and on. These are broken down into categories. The majors, which involve the US dollar and are the most traded. The minors, which are pairs of other major economies that don't include the US dollar. And the exotics, which pair a major currency with one from a smaller or emerging economy. The beginner's temptation is to chase the action. You'll see a news alert that the Japanese yen is making a huge move, so you jump into US dollar to Japanese yen. Then you'll hear a podcast talking about a setup in the Australian dollar, so you pull up the Australian dollar to US dollar chart. You're constantly reacting, bouncing from one battlefield to another, never truly understanding the terrain of any single one. This is a critical error. It's the path to analysis paralysis and, for many, financial frustration. Every single currency pair is its own unique ecosystem. It has its own personality, its own rhythm, its own set of habits. The euro to US dollar, for example, is the most traded pair in the world. It's like the superhighway of the Forex market. It generally has high liquidity, meaning lots of buyers and sellers, which typically translates to tighter spreads. That's the small cost you pay to enter a trade. It tends to be heavily influenced by news from both the US Federal Reserve and the European Central Bank. It's most active during the London and New York trading sessions. Now, compare that to a pair like pound sterling to Japanese yen, sometimes nicknamed the Dragon or the Widowmaker, for its wild volatility. It can move hundreds of pips in a single day. It reacts not only to economic data from the UK and Japan, but also to broader market risk sentiment. When investors are feeling confident, they might buy it. When they're scared, they might sell it. It behaves completely differently from the euro to US dollar. Trying to master both of these plus 5 others, right from the start is an exercise in futility. By focusing on just 1 or 2, you give your brain a chance to do what it does best: recognize patterns. You start to develop a sixth sense for that specific pair. You learn its typical daily range. You begin to notice, every time it approaches this specific price level, it seems to stall out. Or, when this type of news comes out from the US, it tends to react this way, but when similar news comes from Europe, the reaction is different. This deep knowledge is your edge. You're no longer just looking at generic lines on a chart. You're interpreting the behavior of an entity you've come to know intimately. This dramatically simplifies your trading. Instead of scanning 20 charts for a potential setup, you're focused on one. You're not worried about what the New Zealand dollar is doing because it's not your business. Your business is the euro versus the US dollar. That's it. This focus reduces stress, minimizes mistakes caused by information overload, and allows you to build a robust, specialized strategy. So how do you choose? As a trader in the United States, you have a distinct home field advantage. My strong suggestion is to start with a major pair that includes the US dollar. Think euro to US dollar, pound sterling to US dollar to Japanese yen, or US dollar to Canadian dollar. Why? First, because you live and breathe the US economy. You hear about US inflation on your local news. You understand the significance of a jobs report from the Bureau of Labor Statistics. When the Federal Reserve Chairman speaks, it's all over your news feeds. One half of your chosen currency pair's equation is already a part of your daily life. This makes understanding the fundamental drivers of your pair so much easier. You're not trying to become an expert on both the Swiss and the Canadian economies overnight. You're leveraging knowledge you already possess. Second, consider your schedule. The Forex market is open 24 hours a day, 5 days a week, but it's not always active. The real action happens when major financial centers are open. The three main sessions are the Tokyo session, the London session, and the New York session. The magic, for US traders, often happens during the overlap between the London and New York sessions. This typically occurs from 8 a.m. to 12 p.m. Eastern Time. This is when two massive markets are open simultaneously, leading to high liquidity and significant price movements. If you work a standard 9-to-5 job in the US, pairs like euro to US dollar and pound sterling to US dollar are perfect. Their most active hours align directly with your morning. You can trade before work or during your lunch break without having to stay up until 2 a.m. to trade the Tokyo session. Your chosen pair should fit your lifestyle, not the other way around. Let me tell you a quick story about two fictional beginner traders, Alex and Ben. Alex was ambitious. He funded his account and wanted to make money fast. He subscribed to a signal service that sent alerts for over 15 different currency pairs. On Monday morning, he got an alert for a trade on Australian dollar to Canadian dollar. He took it, not really knowing anything about either currency. He lost. An hour later, an alert for euro to Japanese yen came through. He jumped in, hoping to make back his loss. That one went sideways for hours, tying up his capital and his mental energy. By the end of the week, he had placed 20 trades on 12 different pairs. He was exhausted, confused, and his account was down 10%. He couldn't tell you why any of his trades worked or failed. He was just a passenger on a chaotic ride. Ben took a different approach. He decided he would learn one thing and learn it well, the euro to US dollar. For the first 3 months, he didn't even place a real trade. He just watched it. He opened its chart every single day. He read the economic news from the Eurozone and the United States. He noted how the pair reacted to interest rate announcements. He tracked its movement during the London-New York overlap. He kept a journal, not of trades but of observations. Today, the price bounced perfectly off the 1.0800 level. He'd write. US inflation came in higher than expected, and the pair dropped 50 pips in 10 minutes. When Ben finally started trading with a small live account, he wasn't guessing. He had a feel for the euro to US dollar. He knew its tendencies. He knew which news events to watch for. He knew the key price levels where battles between buyers and sellers often took place. His progress was slower than what Alex had hoped for, but it was real. He built his account brick by brick, based on a solid foundation of specialized knowledge. Ben was becoming a specialist. Alex was just a gambler. Your mission, should you choose to accept it, is to be like Ben. Here is your actionable step for this tip. Pick one major currency pair. Just one. Maybe two if you're feeling adventurous, but I'd stick to one. For the next 90 days, make that pair your entire world. Forget everything else exists. Study its historical charts. Read the news that affects its two home countries. Watch it trade in real time during its most active session. Demo trade it exclusively. Journal its every move. Become a true student of that single market. At the end of those 90 days, your understanding and your confidence will be on a completely different level than someone who spent that same time chasing 20 different pairs. You will have laid a foundation of expertise. Choosing your battlefield and learning its terrain is a massive step. But a warrior with a map still needs a plan of attack. You need a set of rules, a system that tells you when to engage, when to stand down, and most importantly, how to protect yourself from catastrophic losses. This isn't about gut feeling or luck. It's about strategy. And that brings us to the fourth and arguably the most important tip for any new trader: building a rock-solid trading plan and a non-negotiable risk management strategy. This is where we separate the professionals from the hobbyists. Think of a commercial airline pilot. Before she even thinks about pushing back from the gate, she goes through a meticulous, non-negotiable checklist. fuel levels, weather conditions, instrument calibration, flight controls. She doesn't just glance at the sky and say, "Looks good to me." She follows a rigid, proven procedure. Why? Because thousands of feet in the air, with millions of dollars of equipment and human lives at stake, there is zero room for guesswork, emotion, or improvisation. Your trading is no different. The market is a turbulent environment. Your capital is your aircraft and your livelihood. Flying without a plan is not brave, it's reckless. And it's the #1 reason why so many aspiring traders crash and burn. So what does this flight plan for trading actually look like? It's not some mystical document. It's your personal business plan for the markets, and it has several critical components. First, you need to define your goals and your trading style. Are you a day trader, looking to get in and out of the market within a few hours? Or are you a swing trader, holding positions for several days or weeks? Your plan must reflect this. Your goals should be specific, measurable, and realistic. "I want to make a lot of money" isn't a goal, it's a wish. A real goal sounds like this. My objective is to achieve a consistent 3% return on my demo account per month for 3 consecutive months before I consider trading with a small amount of real capital. See the difference? One is a fantasy, the other is a professional benchmark. Second, your plan must detail your methodology for analyzing the market. How will you find potential trading opportunities? Will you use fundamental analysis, focusing on news events and economic data releases from the Bureau of Labor Statistics or the Federal Reserve? Or will you be a technical trader, using indicators like moving averages, RSI, or MACD on your charts? Maybe a combination of both. You need to write it down. For example, I will only look for trading opportunities on the euro to US dollar pair during the London and New York session overlap. I will use the 50-period and 200-period moving averages on the 1-hour chart to determine the overall trend. This isn't a suggestion, it's a rule you set for yourself. Third, and this is where discipline really kicks in, are your exact entry triggers. What specific event has to happen on the chart for you to click the buy or sell button? It has to be crystal clear with no room for interpretation. A good rule might be, in an uptrend, I will enter a long position only after the price pulls back to the 50-period moving average and a bullish engulfing candle forms. This removes the temptation to jump into a trade because you have a hunch or you're feeling bored. If the specific conditions of your plan are not met, you do not trade. Period. It's that simple and that difficult. Fourth, you need predefined exit rules for taking profits. Hope is not a strategy. You can't just watch a winning trade and hope it goes higher forever. You need a plan to realize those gains. Will you set a fixed profit target, say twice the distance of your stop loss? Will you use a trailing stop to let your profits run while protecting your downside? Will you exit when the price reaches a key resistance level? Write it down. A professional knows their exit point before they even enter the trade. And this brings us to the most crucial part of your trading plan: your exit rule for a losing trade. This is your stop loss. Your stop loss is the single most important order you will ever use. It is your predetermined point of surrender. It's the eject button you set before the flight even begins. It's the line in the sand that says, "My analysis was wrong, and I am exiting the position to preserve my capital." A stop loss is non-negotiable. You set it on every single trade, and you never ever move it further away in the hopes that the market will turn around. That's how small losses become catastrophic, account-destroying disasters. Now, seamlessly integrated with your trading plan is your risk management strategy. They are two sides of the same coin. If the trading plan is what you do, risk management is how much you do it with. The foundational rule for every beginner is the 1% rule. It's simple. You should never risk more than 1% of your total trading capital on any single trade. Let's make that real. If you have a $5,000 trading account, 1% is $50. That means that if your stop loss gets hit, the maximum amount of money you can possibly lose on that trade is $50. That's it. Why is this so powerful? Because it makes it mathematically very difficult to blow up your account. To lose your entire $5,000, you would have to lose 100 trades in a row. It takes the emotion out of any single loss. A $50 loss is a business expense. It's the cost of gathering information from the market. A $1,000 loss on that same account is an emotional gut punch that leads to revenge trading and a downward spiral. The 1% rule keeps you in the game. Next, you must understand the concept of a risk-to-reward ratio. This is the engine of long-term profitability. It means that for every dollar you risk, you should be aiming to make at least $2 or even $3. This is a 1-to-2 or 1-to-3 risk-to-reward ratio. Let's look at a case study. Imagine you make 10 trades. You follow your plan perfectly, risking 1%, $50, on each trade, with a profit target of 3%, $150. That's a 1-to-3 risk-to-reward ratio. Now, let's say you're not even a great trader yet. You're wrong 70% of the time, so you lose 7 trades. That's 7 times $50, for a total loss of $350. But you win the other 3 trades. That's 3 times $150, for a total gain of $450. After 10 trades with a 30% win rate, you have a net profit of $100. This is the math that allows professional traders to be profitable without having to be right all the time. They focus on the size of their wins being significantly larger than the size of their losses. Finally, risk management and your trading plan come together in something called position sizing. This is how you actually implement the 1% rule. Your position size isn't arbitrary. It's not, I feel like buying one standard lot. It's a precise calculation. You determine where your stop loss needs to be based on your technical analysis. Then, you calculate the exact position size that ensures if that stop loss is hit, you only lose your predetermined 1%. If your stop loss is further away, your position size must be smaller. If it's tighter, your position size can be slightly larger. The risk, that 1%, always stays the same. To tie this all together, you need a trading journal. This is your flight recorder. Every single trade you take, demo or live, gets logged. You write down the currency pair, the entry price, the exit price, your stop loss level, your profit target, the reason you took the trade, and the final profit or loss. Most importantly, you write down how you felt. Were you anxious, greedy, impatient, confident? Reviewing this journal every week is where the real learning happens. You'll spot patterns. Every time I break my rules and trade on a Friday afternoon, I lose. Or, my strategy seems to work incredibly well on the pound sterling to Japanese yen pair, but not on Australian dollar to US dollar. The journal turns your trading from a series of random events into a database of performance that you can analyze and improve upon. It's the ultimate tool for accountability. Building this plan and risk strategy is not the most exciting part of trading. It's not about big flashy wins. It's the quiet, disciplined work you do before the market even opens. But it is the foundation upon which any potential long-term success is built. It's what transforms you from a gambler pulling a lever into a pilot executing a flight plan. It's what gives you the structure and the confidence to navigate the markets and stay in the air long enough to reach your destination. Now, with our plan in place, we need to understand the psychological battlefield that every trader faces. Because the best plan in the world is useless if you don't have the mindset to execute it. And that leads us to our 5th and final tip. Master your trading psychology. This is the final piece of the puzzle, the one that separates the consistently profitable traders from the 90% who fail. Because in the world of Forex, you are not fighting the market. You are not fighting hedge funds or big banks. The only true opponent you will ever face is the one staring back at you in the mirror. You are fighting millions of years of human evolution, primal instincts that served our ancestors well on the savannah, but are absolutely catastrophic in the financial markets. Let's meet the 2 primary villains of this story: fear and greed. They are the twin sirens luring your trading account onto the rocks. First, let's talk about fear. Fear in trading wears many masks. There's the fear of missing out, or FOMO. You see the euro/dollar pair rocketing up without you. Every tick higher feels like a personal insult. Your plan says to wait for a pullback, for a clear entry signal, but the fear screams, you're being left behind. Everyone else is getting rich. Jump in now before it's too late. So you abandon your plan, buy at the very top just as the market reverses, and you're left holding a losing position wondering what just happened. Then there's the fear of losing money. You're in a good trade, it's moving in your favor, but you're so terrified of giving back those small profits that you close the trade way too early, grabbing a handful of pips when your analysis showed it had the potential to run for hundreds. You snatch defeat from the jaws of victory, not because the market was wrong, but because your fear wouldn't let you be right. And perhaps the most insidious of all is the fear of being wrong. This is an ego trap. You enter a trade and it immediately goes against you. Your stop loss is approaching. Your plan, your rational brain, is telling you to take the small, manageable loss and move on. But your ego, your fear of admitting a mistake, whispers, no, it'll turn around. Just move your stop loss a little further down. Just give it more room. This is how a small disciplined loss turns into a catastrophic account-crippling disaster. Fear paralyzes you, it makes you second-guess your strategy, and it turns you from a market analyst into a deer in the headlights. On the other side of the coin is its equally destructive twin, greed. Greed is that intoxicating rush you feel after a string of winning trades. You start to feel invincible, like you've figured out the market. You think, if I made $100 risking 1%, I could make $1,000 risking 10%. Your trading plan, with its carefully calculated position sizes, gets thrown out the window. You double down, then you triple down, chasing that euphoric high. You take on way more risk than you can handle, convinced you've got the Midas touch. But the market doesn't care about your winning streak. Does what it always does. And when that one oversized, reckless trade turns against you, it doesn't just erase your previous gains. It can wipe out a significant portion of your capital in a single blow. Greed convinces you to hold on to a losing trade far too long, fueled by a desperate hope that it will come back. Hope is a beautiful human emotion, but in the Forex market, hope is a four-letter word. It is the gambler's anthem, not the trader's strategy. So how do we defeat these two inner demons? We don't. We can't eliminate fear and greed. They are part of our human DNA. The goal is not to become a robot devoid of emotion. The goal is to become a disciplined operator who can acknowledge these emotions, feel them, and then act according to a predefined, rational plan anyway. The solution is to cultivate the mindset of a professional, a stoic trader. And this mindset is built on three core pillars. The first pillar is radical acceptance. You must accept, deep in your bones, that losses are an unavoidable and absolutely necessary part of trading. They are not a reflection of your intelligence or your worth as a person. A loss is simply a business expense. Think of it like this: if you owned a coffee shop, you would have to buy coffee beans, milk, and cups. That's the cost of doing business. You wouldn't have an emotional breakdown every time you had to pay your supplier. In trading, losses are your coffee beans. They are the cost you pay for the opportunity to catch winning trades. You cannot control the outcome of any single trade. There is a random element to the market, but you can, 100% of the time, control your process. You can control your entry, you can control your exit, and you can control how much you risk. Accept that you will have losses, plan for them, and treat them as a normal part of your operations. The second, and arguably most important pillar, is focusing on process over outcome. This is a mental shift that will change everything for you. Your job as a trader is not to make money on every trade. Your job is to flawlessly execute your trading plan on every single trade. Let me repeat that. Your job is to execute your plan, not to be right. You can follow your plan perfectly, enter at the right time, set your stop loss correctly, and still have the trade result in a loss. Guess what? That was a successful trade. Why? Because you demonstrated discipline. You reinforced good habits. You acted like a professional. Conversely, you could break all your rules, take a wild, impulsive gamble, and get lucky with a winning trade. That was an unsuccessful trade. It was a failure, because it reinforced destructive habits that will eventually lead you to ruin. You have to detach your sense of accomplishment from the profit and loss of a single trade, and attach it to your ability to follow your rules. When you do that, you free yourself from the emotional roller coaster of the market and start thinking in terms of probabilities, just like a casino. The casino doesn't know if the next spin of the roulette will be red or black, and it doesn't care. It just knows that over thousands of spins, its statistical edge will play out. Your trading plan is your edge. Your only job is to spin the wheel again and again and again. The third pillar is the practical tool that ties it all together: the trading journal. This is your secret weapon for psychological mastery. A trading journal is not just a spreadsheet where you log your profits and losses. It is your therapist, your coach, and your harshest critic. For every single trade you take, you must write down not just the technical details, the currency pair, entry price, exit price, but the why. Why did you take this trade? What did your analysis show? And most importantly, what was your emotional state? Were you feeling impatient, anxious, overconfident? Were you following your plan to the letter? Or did you deviate? Then, at the end of every week, you review your journal. You look for patterns. You might discover that most of your losing trades happen on Friday afternoons when you're tired and trying to force a trade before the weekend. Or you might realize that every time you have 3 winning trades in a row, your 4th trade is an oversized, greedy gamble that ends in a huge loss. The journal exposes your psychological weaknesses in stark, undeniable black and white. It forces you to confront the mistakes that your mind would prefer to forget. It is the ultimate accountability tool. Ignoring this step is like a professional athlete refusing to watch game tape. It's choosing to remain blind to the very things that are holding you back. These 5 tips: understanding the market structure, mastering risk management, developing a robust strategy, creating a detailed trading plan, and finally mastering your own psychology, are not just suggestions. They are the non-negotiable pillars of a successful trading career. They are interconnected. Your risk management plan won't work if greed makes you ignore it. Your strategy is useless if fear prevents you from executing it. Your trading plan is just a piece of paper if you don't have the discipline to follow it. It all comes down to the battle within your own mind. The Forex market is a relentless mirror, reflecting your own discipline, patience, and emotional control right back at you in your account balance. The journey to becoming a successful trader is not about finding a holy grail indicator or a secret strategy. It's a journey of self-mastery. And this journey of self-mastery leads us directly to the single most critical, non-negotiable pillar of trading. It's the one thing that separates the amateurs who blow up their accounts in a few weeks from the professionals who are still here years later, consistently navigating the markets. This isn't about finding the perfect entry or exit. It's about survival. Our third tip, and arguably the most important you will ever hear, is to become an absolute master of risk management. Think of it this way: you're not a trader. You are the CEO, CFO, and sole employee of a high-performance hedge fund called You Incorporated. Your trading capital is your company's entire asset base. Now, what is the first and foremost duty of any CEO? It's not to chase speculative, high-risk ventures. It is to ensure the company doesn't go bankrupt. It's capital preservation. Before you can even think about growth, you must guarantee survival. In the world of Forex, risk management is your survival handbook. Let's use an analogy. Imagine 2 deep-sea divers. The first diver, let's call him the gambler, is mesmerized by tales of sunken treasure. He buys some basic gear, sees a promising spot on the map, and just jumps into the ocean, swimming down as fast as he can. He has no idea how much air is in his tank, no plan for decompression, and no emergency ascent procedure. He might get lucky and find a gold coin on his first dive. But eventually, inevitably, he will go too deep, misjudge his air supply, and never make it back to the surface. His diving career is over. Now, consider the second diver, the professional. Her primary goal is not finding treasure on any single dive. Her primary goal is to be able to dive again tomorrow, and the day after that for years to come. Before she even touches the water, she meticulously calculates everything. Her oxygen tank, that's her trading capital. She knows exactly how much she has. She plans her maximum depth. That's her stop loss. It's the point at which, no matter how tempting the view below is, she knows she must begin her ascent to protect herself. She calculates her bottom time and her ascent rate. She has a plan. Finding treasure is a byproduct of her flawless execution and discipline, not the primary objective. You must be the professional diver. The market is the deep, unpredictable ocean. Your risk management is your oxygen tank and your dive plan. It's the only thing that ensures you can come back to trade another day, even after a series of losing trades which are guaranteed to happen. So how do we do this? It boils down to a few simple mathematical rules that you must treat as law. The first and most famous is the 1% rule. This rule is your lifeline. It states that you should never, ever risk more than 1% of your total trading capital on a single trade. If you have a $10,000 account, your maximum acceptable loss on any one trade is $100. Period. If you have a $1,000 account, it's $10. This sounds incredibly small and perhaps even boring to a beginner who's dreaming of big, fast profits. But its power is monumental. By risking only 1%, you could have 10 losing trades in a row. A terrible losing streak by any measure. And you would have only lost about 10% of your capital. You would be emotionally bruised for sure, but you would still be in the game. Your business would still be solvent. You could take a step back, analyze what went wrong, and get back to work. Now, imagine the trader who risks 10% of their account per trade. That same 10-trade losing streak doesn't just hurt them. It completely wipes them out. Their business is bankrupt. Game over. The 1% rule isn't about limiting your profits. It's about guaranteeing your longevity. The second part of this system is the practical application of that rule. The stop-loss order. A stop-loss is a preset order you place with your broker to automatically close your trade if the price moves against you to a specific point, your predetermined maximum acceptable loss. It is the automated execution of your 1% rule. A stop loss is not an admission that you might be wrong. It is a declaration that you have a plan for when you are wrong. It's a calculated business expense, not a personal failure. Placing a trade without a stop loss is like driving a car with no brakes. You might be fine for a while, but you are one unexpected event away from a catastrophic crash. It removes the toxic emotions of hope and fear from a losing trade. You no longer have to sit there, staring at the screen, heart pounding, as the trade goes deeper and deeper into the red, praying for it to turn around. The decision has already been made. It's a mechanical, unemotional business process. Finally, the third piece of the risk management puzzle is the concept of asymmetric risk, more commonly known as the risk-to-reward ratio. This is where trading starts to feel less like a coin flip and more like a calculated business venture. It simply means that the amount of profit you are targeting on a trade should be a multiple of the amount you are risking. A common minimum that professional traders look for is a 1-to-2 or 1-to-3 risk-to-reward ratio. Let's break that down. If you follow your 1% rule on a $10,000 account, you're risking $100. A 1-to-3 risk-to-reward ratio means you will only take that trade if you have a realistic target of making $300 in profit. Why is this so powerful? Because it completely flips the odds in your favor over time. Let's run a case study. Meet trader Ben. Ben has a trading strategy that is not very good. In fact, he's only right 40% of the time. He loses more trades than he wins. But Ben is a master of risk management. He follows the 1% rule religiously, and he never takes a trade unless it offers a 1-to-3 risk-to-reward ratio. Let's look at Ben's last 10 trades. He lost 6 of them. Each loss cost him 1% of his account. So 6 losses times 1% equals a 6% loss. But he won 4 trades. Each win made him 3% on his account. So 4 wins times 3% equals a 12% gain. After 10 trades with a losing strategy, Ben's account is up 6%. 12% in gains minus 6% in losses. He was wrong 60% of the time and his account grew. This is the hidden mathematics of professional trading. Your success is not determined by how often you are right. It is determined by how much you make when you are right versus how much you lose when you are wrong. By insisting on a positive risk-to-reward ratio, you can be wrong most of the time and still build your account. This is how you transform trading from a game of chance into a game of skill and statistical probability. For traders in the United States, the regulatory environment often limits leverage to 50-to-1 for major pairs. While some might see this as a disadvantage compared to offshore brokers, it can be a blessing in disguise for a beginner. It naturally discourages over-leveraging and forces you to be more deliberate with your capital, reinforcing these very principles of sound risk management from day one. Your primary job is not to be a market analyst or a fortune teller. It is to be a professional risk manager. You must fall in love with the process of protecting your capital. You must find satisfaction not just in winning trades, but in cutting losing trades short with ruthless efficiency. Because every dollar you save from a bad trade is another dollar you have to deploy on a future, high-probability opportunity. Mastering this single skill, the art of defense, is what gives you the staying power to eventually learn how to master offense. And now that you've built your fortress, now that you understand how to protect your capital, it's time to talk about the weapons of offense. It's time to talk about the one tool that makes Forex so incredibly alluring to millions of people. It's the single biggest reason beginners flock to this market, and it's also the single biggest reason 90% of them fail. We're talking about leverage. Leverage is a financial superpower. It's the ability to command a massive army with only a small handful of soldiers. In the world of Forex, it means you can control a large position in the market with a very small amount of your own money. For example, with a leverage ratio of 50-to-1, which is the standard cap for major pairs here in the United States, for every $1 you put up, your broker lets you control $50 in the market. So, with just $2,000 of your own capital, you can command a position worth $100,000. Sounds amazing, right? It's the ultimate force multiplier. It's what allows someone with a modest account to potentially see the kinds of returns that would otherwise be reserved for Wall Street hedge funds. And this is the siren song of leverage. It whispers in your ear about all the incredible possibilities. It shows you charts where a tiny little move in the market could translate into a huge swing in your account balance. But here's the critical truth that gets buried under all that excitement. A superpower that isn't understood and respected is the fastest path to self-destruction. Leverage doesn't just magnify your wins. It magnifies your losses with the exact same brutal efficiency. To truly understand this, you need to understand its counterpart, margin. People get confused by this all the time. Margin is not a fee. It's not a cost of doing business. Margin is a good faith deposit. It's the portion of your own money that you have to set aside to open and maintain a leveraged position. Think of it like a security deposit on an apartment. You're not spending that money, but it's locked up to cover any potential damages. In trading, that damage is a losing trade. So, if you want to open that $100,000 position with 50-1 leverage, your required margin is $2,000. That $2,000 is taken from your account and held by the broker. It's your skin in the game. The remaining money in your account is your usable margin, which is the buffer you have to absorb any losses before things get really bad. And this is where the story turns dark. This is where we meet the grim reaper of new traders, the margin call. Let's imagine a new trader. We'll call him Alex. Alex has saved up $5,000. He's been watching videos, he's excited, and he's ready to make his mark. He sees the euro versus the US dollar making a move he thinks he recognizes. He feels that jolt of adrenaline, that certainty that this is the one. He wants to maximize his potential outcome, so he decides to use his full power. He opens a large position using almost all of his available margin. His $5,000 account is now controlling a $250,000 position in the world's largest financial market. He feels like a king. For a few minutes, the trade goes his way. He's up a few $100. The euphoria is real. He's thinking, this is it. This is the new life. Then the market turns. A piece of unexpected news comes out of Europe, and the pair starts moving against him. First it's small. His profit evaporates. Now he's down $100. No big deal, he thinks. It'll turn back around. The trend is my friend. But it doesn't. The price keeps dropping. He's now down $500. Then $1,000. That feeling of power is replaced by a cold knot in his stomach. His usable margin, his buffer, is shrinking fast. He's watching his account balance bleed out in real time, glued to the screen, his heart pounding with every tick downwards. He's now down over $4,000. His initial $5,000 account is now worth less than $1,000. His usable margin is almost completely gone. And then it happens. He gets an automated notification from his broker. It's a margin call. The broker's system automatically closes his position at a massive loss to ensure he doesn't lose more money than he has in his account, and to ensure the broker gets their money back. In the span of a few hours, $5,000 of hard-earned money has been reduced to just a few hundred. His account is wiped out. The dream is over. That is the reality of misusing leverage. Alex treated it like a tool for generating profit, when he should have first viewed it as a tool for managing risk. This story isn't an exaggeration. It happens every single day to thousands of aspiring traders around the world. They see leverage as a shortcut to wealth, but they fail to see that it's also an expressway to ruin. A 1% move against you in the market without leverage means you lose 1% of your capital. With 50-1 leverage, that same 1% move against you means you lose 50% of your capital. The market only has to hiccup, it only has to move slightly against you to completely obliterate your account. So what's the lesson here? Do we avoid leverage altogether? Not necessarily. The lesson is to treat it with the extreme respect it deserves. Here in the United States, the regulators at the CFTC have put rules in place to protect retail traders from themselves, capping leverage at 50-1 for major currency pairs and 20-1 for minor ones. In some other parts of the world, you might see brokers offering insane leverage like 500-1 or even 1,000-1. That isn't a feature. It's a trap. It's a business model designed to churn through beginner accounts as quickly as possible. The professional traders, the ones who do this for a living, have a completely different relationship with leverage. Most beginners assume the pros use the highest leverage possible. The truth is the exact opposite. Most seasoned professionals use incredibly low levels of leverage, sometimes as low as 5-1 or 10. Why? Because their primary goal isn't to hit a home run on a single trade. Their goal is survival. Their goal is consistency over the long term. They know that high leverage introduces a level of volatility and risk that makes a long-term career in trading almost impossible. They use leverage not to gamble, but as a tool for capital efficiency, allowing them to take on multiple, well-managed, low-risk positions at once. For you, as a beginner, your first step should be to trade on a demo account with zero leverage. Get a feel for the market. Then, when you do go live with real money, start with the absolute lowest leverage your broker will allow. Maybe 5-1, or 1 at the most. Don't even think about 50-1. Your goal is not to double your account in a week. Your goal is to still have an account in 6 months. By learning to trade profitably with low leverage, you are forcing yourself to develop a real edge, a real skill in reading the market. You're learning to rely on your analysis, not on a financial steroid that can backfire with catastrophic consequences. Leverage isn't your strategy, it's a tool. A dangerous one. It's like a chainsaw. In the hands of a skilled lumberjack, it can build a house. In the hands of a child, it leads to a trip to the emergency room. Before you even think about using it to build your fortune, you must first master the art of not cutting your own leg off. And mastering this tool is only one part of the equation. Because even with the perfect strategy, the perfect risk management, and the perfect understanding of leverage, there is one final boss you have to defeat. And this opponent isn't in the charts, it isn't in the news, and it isn't your broker. It's the opponent staring back at you in the mirror. It's the opponent that knows all your weaknesses, your impatience, your tendency to get greedy after a win, or your desire for revenge after a loss. This brings us to our fifth and final tip, and honestly, it's the one that ties everything else together. Without this, technical analysis, fundamental analysis, and even perfect risk management will eventually fall apart. Tip number 5 is, master your trading psychology. The Forex market, more than almost any other arena in the world, is a masterclass in psychological warfare. It is an environment precision engineered to exploit the most primal human emotions. Think about it. Flashing lights, rapidly changing numbers, the potential for significant financial outcomes on the line with every click. It's a system designed to trigger fear and greed. And if you don't have a plan to manage these emotions, you're not trading against other people. You're trading against millions of years of human evolution that is screaming at you to do the exact wrong thing at the exact wrong time. Let's break down the main villains in this psychological drama. First, there's the big one, fear. Fear manifests in 2 primary ways. The first is the one you've all heard of, FOMO, the fear of missing out. Imagine this scenario. You're watching the US dollar to Japanese yen. It's been consolidating for days, and you've been patiently waiting for a breakout. Suddenly it happens. A huge green candle appears. Then another. And another. Your social media feed is exploding. News headlines are flashing. You feel that pit in your stomach, that frantic energy telling you, this is the move. The one I've been waiting for. If I don't get in right now, I'm going to miss out on all the profits. So you abandon your plan. You forget about waiting for a proper entry signal or a pullback. You just smash the buy button right at the top of the move. And for a moment you feel a rush of relief. You're in. But then the momentum stalls. The price hangs there and slowly it starts to tick back down. The people who got in early are taking their profits, and you're the one providing them the liquidity to do so. Your entry, driven by pure FOMO, has now become the perfect exit for disciplined traders. The other side of fear is the fear of losing. This can be just as destructive. It's when you have a perfectly good trade setup according to your plan. Everything aligns, but you hesitate. You're paralyzed by the thought of the trade going against you. You think about your last loss and the feeling of being wrong. So you do nothing. You watch as the trade plays out exactly as you predicted, hitting the profit target you would have set, all while you sat on the sidelines. Or worse, you do get into a good trade, it moves a little bit in your favor, and you immediately close it for a tiny profit because you're terrified of it turning around and becoming a loser. You walk away with a $10 gain on a trade that had the potential for a $100 outcome, completely sabotaging your risk-to-reward ratio. Fear makes you buy high, sell low, and stay out of the market when you should be in it. Next up is fear's evil twin, greed. Greed is what happens after you've had a few successful trades. You start feeling invincible. You think you've cracked the code. You start telling yourself, my 1% risk rule is too conservative. I know what I'm doing now. So on the next trade, you ramp up your leverage. You risk 5, maybe even 10% of your account on a single idea. You're no longer trading your plan. You're chasing a feeling. You're trying to get that dopamine hit of a massive win. And for a while it might even work. But the market has a way of humbling everyone. One trade, just one single trade that goes against you with that kind of risk, can wipe out weeks or even months of hard-earned progress. Greed also manifests as an inability to take profits. Your trade hits your predetermined take-profit level. Your plan, which you created when you were calm and rational, is telling you the trade is over. Take the money and move on. But greed whispers in your ear. What if it goes higher? Look at that momentum. You could double your profit if you just hold on a little longer. So you ignore your plan. You hold. The market continues up for a few more pips and you feel like a genius. And then it reverses. And it reverses hard. It blows past your original take-profit level, erases all your gains, and often turns a brilliant winning trade into a frustrating loser. All because you got greedy. And that brings us to the most dangerous emotional state of all. The desire for revenge. This is what happens after you take a loss, especially one that feels unfair. The market stopped you out to the exact pip before reversing in your intended direction. You feel cheated. You feel angry. And that anger demands action. So you immediately jump back into the market. No plan, no analysis. You just want to get your money back from the market. This is called revenge trading. It is the single fastest way to destroy a trading account. You're not making decisions based on probabilities anymore. You're gambling based on rage. You double your position size, you take a subpar setup, and you inevitably compound your initial loss with a second, much larger one. It's a death spiral fueled entirely by emotion. So how do you fight back? How do you defeat this opponent in the mirror? You can't eliminate these emotions. They're part of being human. But you can build systems to manage them. First, your greatest weapon is a non-negotiable, written-down trading plan. I mean a physical document or a file on your computer. It must define your exact entry rules, exit rules, and risk management rules. When you feel FOMO, you look at your plan. Does this situation meet my entry criteria? No? Then you don't trade. When you feel greedy and want to hold a winner past your target, you look at your plan. Does it say to take profit here? Yes. Then you close the trade. Your plan is your objective constitution, written by your rational self to protect you from your emotional self. Second, you must keep a detailed trading journal. And I don't just mean tracking your entries, exits, and profit or loss. I mean journaling your emotions. For every single trade, write down how you felt before, during, and after. Were you anxious when you clicked the button? Were you overconfident? Did you feel angry after being stopped out? Over time, you will identify your personal psychological patterns. You'll see that maybe you tend to overtrade after a big win, or take bad setups on Friday afternoons. Awareness is the first step to correction. Your journal is your therapist and your coach rolled into one. Third, develop pre-market and post-market routines. Professional athletes don't just run onto the field. They have rituals that get them into the zone. You need to do the same. Your pre-market routine could be reviewing your charts, checking the economic calendar for major U.S. news events, and reading your trading plan aloud. This prepares you for a session of disciplined execution. Your post-market routine is even more important. After you're done trading for the day, you journal your trades, review your performance, and then, and this is critical, you shut it down. Turn off the charts. Walk away. Go to the gym, spend time with family, read a book. You have to give your mind a break from the market to avoid burnout and emotional fatigue. Finally, you need to fully embrace a probabilistic mindset. No trading strategy in the world wins 100% of the time. Not one. The best professionals might only be right 50 or 60% of the time. They make their money because their winning trades are significantly larger than their losing trades. Once you truly accept that any single trade can be a loser, regardless of how perfect the setup looks, you begin to detach your ego from the outcome. A loss is no longer a personal failure. It's simply a business expense. It's a data point in a long series of trades that, over time, will express your statistical edge. Mastering your mind is the final frontier in trading. It's the difference between a gambler and a strategist. But now that you have these 5 core pillars, you might be asking, where do I actually start? How do I put all this into practice without risking my life savings? That's where the concept of a demo account comes in, and it's the single most important first step you'll ever take. We're going to break down exactly how to use it, not just to practice clicking buttons, but to forge yourself into the trader you want to become. Think of a demo account not as a video game, but as a multi-million-dollar flight simulator. A prospective fighter pilot doesn't just hop in and do barrel rolls for fun. They spend hundreds of hours in that simulator, practicing takeoffs, landings, emergency procedures, and combat maneuvers under every conceivable condition. They do this until the controls are an extension of their own body, until their reactions are instinct, until they have proven they can handle the pressure before ever setting foot in a real cockpit where one mistake could be catastrophic. Your demo account is your flight simulator. The market is the real cockpit, and most beginners treat it like an arcade game, And that is why they crash and burn. The biggest mistake, the cardinal sin of demo trading, is treating the fake money like it's fake. A broker gives you a $100,000 or even $1 million demo account. You feel rich. You feel powerful. So what do? You place a massive trade on the euro to US dollar pair. You risk $20,000 on a single whim because, hey, it's not real, right? If it goes up, you get a huge dopamine hit. You feel like a genius. If it goes down, you shrug and say, oh well, it was just practice money. And you open another massive trade to try and win it back. You're not learning how to trade. You're learning how to gamble. You are building the worst possible habits. You're training your brain to be reckless, to ignore risk, to chase losses, and to rely on luck. These are the very habits that will vaporize your real money with terrifying speed once you go live. So let's talk about how to use the simulator like a professional pilot. The very first thing you must do is treat it like it's real. When you open your demo account, I want you to immediately adjust the balance to the exact amount you realistically plan to start trading with. If you plan to fund your live account with $2,000, your demo account needs to be $2,000. Not a penny more. If it's $500, it's $500. Why? Because trading is a game of percentages and psychology. The psychology of managing a $1,000 account is a completely different universe from managing a $100,000 account. On a $1,000 account, a responsible risk per trade might be $10. On a $100,000 account, it could be $1,000. By using a realistic balance, you are forced to learn how to use proper position sizing from day one. You learn what a realistic profit and loss looks like. A 30-pip gain on a $1,000 account might be $6. Doesn't feel like a lottery win, and it shouldn't. Feels like a well-executed plan. You are training yourself in the reality of the business of trading, not the fantasy. Next, before you place a single trade, you will write down a trading plan. This doesn't have to be a 50-page document. It can be a simple checklist. But it must be written. Your plan needs 3 core components. 1. Your entry criteria. What specific conditions must be met on the chart for you to even consider entering a trade? Is it a certain candlestick pattern? Is it the price bouncing off a key support level? Is it a moving average crossover? Be specific. Write it down. I will only buy when the price is above the 50-period moving average and forms a bullish engulfing candle. 2. Your exit criteria. This is twofold. First, where's your stop loss? This is the price at which you admit you were wrong and automatically exit the trade to prevent further losses. It is non-negotiable. Second, where's your take profit? The price at which you will exit the trade and secure your gains. 3. Your risk management rule. This is the most important rule of all. A common rule for beginners is the 1% rule. You will never risk more than 1% of your account balance on any single trade. On a $2,000 account, that means your maximum potential loss on a trade, as defined by your stop loss, is $20. Period. With your realistic account balance and your written trading plan, you are now ready to start. And as you trade, you will do something that separates the amateurs from the pros. You will keep a detailed trading journal. This is your secret weapon. For every single trade you take, you will log the following: the date, the currency pair, your reason for entry based on your plan, the entry price, the stop loss price, the take profit price, and the final outcome of the trade. But here's the most critical part that almost everyone skips. You will also log your emotional state. Before, during, and after the trade. Were you feeling confident? Anxious? Greedy? Did you exit early because you were scared of losing profits? Did you move your stop loss because you were hoping the trade would turn around? Be brutally honest with yourself. This journal is not for anyone else. It's for you. It is the raw data of your trading performance and your psychological tells. Let me tell you a story about 2 aspiring traders. We'll call them Alex and Ben. They both start at the same time, excited about the potential of Forex. Alex gets a $100,000 demo account. He jumps in, starts placing huge trades, and within a week, he's up a make-believe $30,000. He feels invincible. He thinks he's a natural. He doesn't have a plan. He just trades on gut feeling. He ignores the trades that lose him $10,000 because he focuses on the big winners. After a month, he feels he's ready. He funds a real account with $2,000, and trying to replicate his demo success, he places a huge, over-leveraged trade. The market moves against him. He freezes. The fear of losing real money is paralyzing, something he never felt in the demo. He doesn't follow a plan because he never had one. Within 2 weeks, his account is gone. Now let's look at Ben. Ben also starts with a $2,000 demo account, the amount he plans to go live with. He writes a simple trading plan based on support and resistance and commits to the 1% rule. His first week, he actually loses a little money, about $40. But he's not discouraged. For every trade, he fills out his journal. He notes that he felt anxious on his winning trades and kept closing them too early. He sees in his data that if he had just stuck to his original take-profit target, his winning trades would have been 3 times larger than his losing trades. For the next month, he focuses on one thing only: following his plan perfectly regardless of the outcome. He forces himself to let his trades run to either his stop-loss or his take-profit. By the end of his second month, his demo account is up to $2,180. It's not a fortune, but that's not the point. He has proven to himself that his strategy has a positive expectancy. He has mastered the mechanics of his trading platform. And most importantly, he has forged the iron discipline to follow his rules. When Ben funds his real $2,000 account, nothing changes. The screen looks the same. The plan is the same. The risk is the same. He's not a gambler. He's an operator executing a tested business plan. The goal of the demo account is not to make $1 million fake dollars. The goal is to achieve 3 things. First, to prove that your trading plan is consistently profitable, even if only by a small amount over a sample size of at least 50 to 100 trades. Second, to achieve unconscious competence with your trading platform. You should be able to place an order, adjust a stop-loss, and analyze a chart as easily as you tie your shoes. And third, to build the unshakable discipline to follow your plan, even when it's boring and even when you're losing. You don't graduate from the demo account until you can look at your journal and see a track record of disciplined execution and consistent results. Once you have done this, once you've used the simulator to build the skills and habits of a professional, you are prepared to enter the live market. You've done the hard work that 90% of people skip. But even with the perfect habits and a proven plan, your success can be instantly derailed if you fail to understand the fundamental forces that actually move these currency pairs up and down. It's one thing to react to patterns on a chart. It's another thing entirely to understand the economic engine driving them. Mastering your own psychology is step 1. The next step is understanding the psychology of the market itself. And that is built on one key concept we have to cover next: RT. It's another thing entirely to understand the economic engine driving them. Mastering your own psychology is step 1. The next step is understanding the psychology of the market itself. And that is built on one key concept we have to cover next. And this brings us to our 5th and final tip, the one that ties everything together. It's the difference between looking at a map and actually understanding the terrain. Tip number 5 is: don't just trade the chart, trade the story. This is what we call fundamental analysis. If technical analysis, looking at charts and patterns, is the what, then fundamental analysis is the why. Why did the euro suddenly drop against the dollar? Why is the Japanese yen showing unexpected strength? The charts will show you that it happened. The fundamentals will tell you the story behind why it happened, and more importantly, why it might continue to happen. For a beginner in the United States, this can sound incredibly intimidating. You hear terms like quantitative easing, consumer price index, and non-farm payroll, and it sounds like a different language. But I want you to reframe it. Think of yourself not as a trader but as a global detective. Every currency pair, like the euro to US dollar or the US dollar to Japanese yen, is a case you're working on. The price chart is your crime scene. It shows you the evidence of what took place. But the fundamentals? That's the motive. That's the backstory. That's where you find the clues that lead to the next big move. And for a US-based trader, the most important character in your detective story is right in your backyard. The United States Federal Reserve, or the Federal. The Fed is the central bank of the United States. Their decisions have a gravitational pull on the US dollar that is almost impossible to overstate. The single most important tool they have is the federal funds rate, which is the baseline interest rate for the country. Think of interest rates as a magnet for global money. When the Fed raises interest rates, it becomes more attractive for international investors to hold US dollars because they can earn a higher return, or yield, on their money. This increased demand can strengthen the dollar. Conversely, when the Fed cuts interest rates, holding dollars becomes less attractive, and capital might flow elsewhere, potentially weakening the currency. As a new trader, you don't need to be an economist who can predict the Fed's every move. But you absolutely need to know their story. Are they in a hawkish mood, meaning they're focused on fighting inflation and likely to raise rates? Or are they dovish, meaning they're more concerned about economic growth and might lower rates? The minutes from their meetings, the speeches by the Fed chair. These are the clues that tell you the direction of the story. The market hangs on every single word. The second major clue in your detective kit is the monthly jobs report, specifically the non-farm payroll, or NFP. This report is released on the first Friday of every month, and for a few minutes, the entire financial world holds its breath. Why? Because it's a direct snapshot of the health of the U.S. economy. It tells us how many jobs were created or lost outside of the farming industry. A strong number suggests the economy is booming. Companies are hiring, people are spending, and the economic engine is running hot. This is often bullish for the US dollar. A weak number can signal a coming recession, which could pressure the Fed to lower interest rates and, in turn, weaken the dollar. The NFP day is famously volatile for a reason. It's a massive plot twist in the monthly economic story. Next up is inflation. You've been feeling this one at the gas pump and the grocery store. The main report to watch is the Consumer Price Index, or CPI. This measures the change in prices for a basket of goods and services. Simply put, it's the rate at which your money is losing its buying power. Why does this matter for Forex? Because fighting inflation is one of the Fed's primary jobs. If inflation is running too high, it puts immense pressure on the Fed to raise interest rates to cool things down. So a surprisingly high CPI report can send the dollar soaring. Not because inflation is good, but because traders anticipate the Fed will act aggressively in response. Understanding this cause and effect relationship is crucial. Finally, there's the gross domestic product, or GDP. This is the country's economic report card. It measures the total value of all goods and services produced. A strong, growing GDP indicates a healthy, expanding economy, which is a fundamental pillar of a strong currency. Now, here's the most important part. Your job as a beginner is not to react in the first 5 seconds after one of these numbers is released. That's a game played by high-frequency trading algorithms, and it's a game you will likely not win. The initial market reaction is often chaotic and misleading. Your job is to step back and ask, how does this new piece of information change the overall story? If the jobs report was a little weaker than expected, but inflation is still high and the Fed has been consistently hawkish, the bigger story hasn't changed. The dollar's overall strength might remain intact. But if you get a series of weak reports over several months, now the narrative is shifting. The detective sees a new pattern emerging. Forex is a relative game. The US dollar isn't strong or weak in a vacuum. It's strong or weak relative to another currency. So the real mastery comes from understanding two stories at once. If the story in the United States is one of rising interest rates and a strong economy, while the story in the Eurozone is one of slowing growth and low rates, what does that tell you about the potential long-term direction of the euro to US dollar pair? It suggests a fundamental pressure pushing the pair downwards. Your technical analysis on the chart can then be used to find a good entry point to trade in the direction of that fundamental tide. When the big story and the chart pattern align, that's when you find some of the highest probability setups. So let's bring it all home. Let's connect all 5 tips into a single cohesive approach. You start with tip 1, a rock-solid trading plan. This is your constitution, defining your rules of engagement before you ever risk a single dollar. Then you apply tip 2, you master one currency pair. You're not trying to solve every case in the world. You become a specialist, an expert on the euro to US dollar or the US dollar to Japanese yen. You learn its personality, its quirks, how it reacts to different news. You protect yourself with tip 3, impeccable risk management. You know exactly how much you're willing to risk on any single trade, using stop losses religiously. This is the shield that keeps you in the game long enough to learn and succeed. You then conquer the internal battlefield with tip 4, mastering your psychology. You understand that fear and greed are your greatest enemies. You trade your plan with discipline, treating wins and losses as simple data points, not emotional events. And finally, you use tip 5, you learn to read the story. You look beyond the squiggly lines on the chart and understand the fundamental economic forces, the story of interest rates, jobs, and growth, that are acting as the wind in the sails of your chosen currency pair. This is how you graduate from being a gambler to being a trader. It's not about finding a magic indicator or a secret strategy. It's about building a professional process. It's a journey that demands patience, discipline, and a relentless desire to learn. The market is the most complex and fascinating puzzle on Earth. It's a reflection of global economics, political shifts, and raw human emotion. The path isn't easy and there are no shortcuts. But by focusing on these core principles, planning, specialization, protection, mindset, and understanding the story, you're not just learning how to trade. You're learning how to think critically, manage risk, control your emotions, and understand the intricate workings of the global economy. These are skills that will serve you far beyond the trading screen. So my challenge to you is this. For the next month, open a demo account. Pick one major pair. And don't focus on making money. Focus on being a detective. Follow the economic calendar. When a big news event happens, pull up the chart. Read about the economic release. Write down in a journal why you think the market reacted the way it did. Connect the story to the price action. If you do this consistently, you will build a foundation of knowledge that is more valuable than any get-rich-quick signal service could ever offer. You'll be building a real sustainable skill. Trade smart, stay disciplined, and never ever stop learning.